All right, you guys, what I wanted to do was shoot a video. A lot of my clients are real estate investors and they try to do their own accounting. So I thought it'd be fun to just kind of show how we book a journal entry for the settlement statement uh, for when you buy a property. So what we're going to show you right first is the deposit. So we've already written a check out of our bank account, $3,000, and we've sent it for earnest money deposit. So if we don't have our earnest deposit that's been going through our business bank accounts paid like from a personal account, then it can throw off numbers because we have to treat this a little bit differently. So in this example, if we paid the earnest money deposit right out of our business bank account, and we didn't have any money in the business bank account just because it's a new account that I just put up there just to write the one check. So that's why it's showing a negative. But obviously, you'd want to have money in your bank account before writing the earnest money deposit. Okay. But in accounting, we have double entry accounting. So if you debit one side, you got to credit the other side. So next steps from here is we've already paid that $3,000 deposit. And so next thing that we need to do is we need to do a journal entry. It's a little bit harder to do this on a small screen, so bear with me. So first thing you need to do is look at your closing documents. So what page do I have it? So we're doing a closing date of 12/18 in this example. So what you're going to do is you're just going to use the settlement statement date for the date that you would be paying money to close on the property. And then journal entry number, you can always put something in there. For this example, we're just going to keep a one in there. And then the way that I look at my settlement statement, my closing disclosures, is the top section here is what I like to kind of think of as assets. The part down here, I like to think as liabilities, and then I like to think about this bottom part as equity. So when you start to see it that way, it makes it a lot easier when you're booking your journal entries. So what I usually start with is just the sales price. We have 730,000 sales price, plus we have closing costs paid at closing, 26,469.08. We're not going to get too detailed on everything. We kind of want to keep this simple because that $26,000, we have to come down to the next page and look at all the closing costs, borrower paid. And what we have to do is we have to really think about these. Okay, are these loan costs? Are they part basis? Are they part loan? Are they part prepaids? So in this example, we're just going to keep it short. We're just going to show that $26,000. We're going to treat it as an asset. So if you're doing your own bookkeeping, if you can get it to this point, that then your CPA can go in and adjust the difference, then you'll be better off. And so on this one, it's just a sample closing disclosure statement. So we're just going to put we bought 123 Main Street. And then what we're going to do is we don't have that in our chart of accounts yet. So we're going to click add. And then we have to tell the system what kind of asset we have. So when we're buying property, we're going to go with fixed assets. And then over here to the right, we're going to click on buildings. And I wouldn't worry about anything down here. We just want to say, hey, let's get this account activated. And then what I like to do, just for simplicity, is the 730 plus the 26. I'll put that at 756, 469.08. That's a debit. And then we're going to come down here. And then on our settlement statement, we've already paid our earnest money deposit. And so now we're on the liability side. So now we are going to do a credit here because what we want that to do is release from our asset from a plus balance to a minus balance. And then the new loan amount, we need to book this new loan amount. So we're going to call this new loan amount. And then we're going to add new. And then when you're setting up your books, you want these to be as detailed as possible. This example, I don't really know who the loan is with and all that other information. Then we're going to click a long-term liability. QuickBooks defaults to notes payable. I like it. I'm going to click save. And then you're going to put the 693,500 because that's a liability on the plus side, setting up the loan. And then in this one, the buyer's got a seller credit of $20,000. Oops. So what I want to do is type 123 Main Street, and then I'm going to reduce this side by $20,000. And then the difference down here, I use a tool that lets me know what the difference is. It's 39,969.08. So what this is going to be is cash to close. And so it's also listed up here just because that amount's a little bit blurry on this side. So what we want to do is if you're going to just write a check, you wrote it for $39,000, which is what most clients do, then the only thing that their financial statements will show is cash going down and $39,000. But we always have to go in and gross everything up, right? So we can pay this out of our bank account, and then that would be a credit, and then we would click save. And now we're going to start to see changes on our balance sheet. I like to just do A, just so we can see everything real quick. Sorry, I'm using a short screen. So I'm going to slide this over real quick so we can, so I'm just going to bump this up. And then we have our financial statements. So we can always go to our profit and loss. And just look and see what QuickBooks did with the entries. See it didn't do any difference. And then on our balance sheet, click A. So now what do we have? So now I'm going to switch over to classic view. Modern view is just harder to scroll down. Got to go back to A, run report. Okay, so now what we're going to see is we haven't put any money in the bank account, so that's why it's showing a negative. But we spent $3,000 on the earnest money. We spent $39,000 to come to the table with cash. And then what we got is now we have an asset, 736,469, and we have a new loan of $693,500. Okay. So now that we have the loan set up, each month that we have to go and make a payment for our property. Sorry, this is getting a little out of hand. I have an amortization schedule that we went and set up. So 693.5, 30-year loan, 5.99. And then what it's going to show you is we don't want to go by month because we're buying this property in December according to our settlement statement. And so we really just care about, okay, what's the interest? What's the principal portion when I make my first loan payment? And I'm going to show you how to go in and do that real quick. And so where we can get those amounts as well as we come down to our statement over here. And there's a page that shows us what the new loan is. And then it shows us that we have a 30-year up here, and then the interest rate. So those are the items needed that we can start to calculate what that monthly payment is going to be. And then you want to get really good at reading these closing disclosures because this is going to give us, okay, principal and interest. This is the amount. If you have mortgage insurance, you have estimated escrow, that could bump up the payment as well. And so we need to know how to adjust. But for the most part, just principal and interest, 4,157 would be that amount right there. And then if we grab the calculator, and I'm hoping all this ties out perfectly, it is 4,157.43. So you can see that when we do a payment, we're going to break out interest and principal. Then these other amounts, it just depends. Hey, are we paying our mortgage insurance or do we have escrow that we got to build up and then release at the end of the year? So we're just going to keep it simple, showing the 4,157. Okay. So I'm going to do a full screen with my QuickBooks. And then we're going to play with this. Hopefully this isn't too scattered. So we have our new loan. Now it's time to make a payment. So remember how we've talked about expenses and checks and bills and bill pays. I like to just use my expense or my check. Those ones are just a lot easier to work with. And then the first payment we need to pay new loan. So whatever your mortgage ends up being, seems like a lot of times we buy a home, they'll sell off the loans pretty quick. You always want to make sure you adjust this to bank account date. So if we bought December 18th, you're really not going to have a mortgage payment until February 2026 because interest is paid in arrears. So now we have to start to think about this case. So when I have that 4,157 payment, then the first part we're going to have to pay is our interest expense. And this is where you have to really start to learn, the assets, the liabilities, the equities versus income, expense, because they hit different reports. So our interest expense, we go over to our thing, 3466.92 is going to go to interest. And then remember, we want to go down, we want to find our liability account where we set up our new loan because this next portion is going to be paying down the actual loan. So now we have our mortgage payment. We broke it out between interest and our pay down on the loan. And we can click save and close. So now if we click on this new loan, we're only going to see it reduced by the principal portion, not the interest portion. Sorry, we are going to have to look at getting faster internet speeds because of this. Okay, so now we can see we set up the new loan amount, and now we have the principal portion, the 690.51. Remember, that's not dropping the full amount because we have to pay the bank. It's interest. And then now we're going to go over to a profit and loss statement. We're just going to click the all dates. So now our interest portion is the 3,466.92. So everything is looking good. So hopefully that'll help you. We kind of went from, the closing documents to the amortization schedule to how to book it inside of QuickBooks. So knowing how to gross it up with the payment that we had to come in to with the closing costs from borrowers. Then when we do the journal entry, we have our asset booked, we have our liability booked, we have our net income is a loss because of our interest portion, and then our cash portion. So the other report that you can run is you start to run your statement of cash flows. And this is going to monitor where your cash is going. So part of that cash is paying down your debt. And so that's what this statement of cash flow report is going to show you is your net your net loss, but also what's happening with your operating, investing, financing on everything as well. So it's going to start with your beginning cash, and then what your ending cash is, cash at the end right here. And so this will be the next report that we really got to go into detail at some point in time. So I'm just trying to think anything else. So the amortization, I just went to calculator.net. And then what I usually do is I like to put in my data. Then you can see it by years, or you can click it by monthly and see how everything goes. Kind of a cool little calculator. Just remember your monthly is going to be a little bit different depending on what month you close on as far as your property. And then let's go over this real quick. And I think it's really important to go over your closing disclosures. What it's going to do, let's just run through it real quick. It's going to talk about the date issued when you got to see the closing disclosures. You always have to get that from your lender before closing date, so you have time to review everything. Over here, it talks about our 30-year. It's a purchase. It's a fixed rate. It's conventional. The sales price is 730. And then our new loan amount. Can this amount increase after closing? No, no, no. Our monthly principal and interest payment. And then these payments down here, mortgage insurance, estimated escrow. Your mortgage statement's going to be higher because of these amounts. So the payment's actually going to be the 4837. And then this estimate includes property taxes, homeowners insurance. It's sitting in escrow, yes and yes. So we may have a little bit of accounting entries there. And we got this. So I would definitely, whenever I am going to book anything, there's lots of ways to sit and understand all the accounting side. But just kind of remember, this is going to go to assets, this is going to go to liabilities. We have a negative cash, or we could have just gone and said, hey, that was paid out of my personal account. This is my business asset, so as a shareholder contribution. So sometimes we just have to make small adjustments on the accounting side, which once you understand the real estate equations, it makes it easier. And then there's times where we break out our basis, our loan fees, and our land. And so if it's a rental property, we really need to go through and say, okay, these are loan costs. Okay, which of these are basis versus loan costs? Because they may be amortized a little bit differently. Which ones are prepaid? So what amounts can I deduct this year versus going into next year? So these are the ones I'd say, hey, probably you can use ChatGPT, something like that. That says, hey, how should I report my appraisal fee, my credit report, my MERS fee, my certification, my tax fee? Which ones of these are loan origination fees that not loan origination fees, but loan fees I need to amortize over 30 years versus which ones can I expense versus which ones are basis. So you want to make sure you're separating those out. And then, as you know, most accountants will just take, the cost up here, 756, take 80% to building that's depreciated, 20% to land. But I would highly recommend that you go to your county report and see how they value the land to the building because everywhere's a little bit different. So an 80-20 split might not be what you need to do for your area. So hopefully this gives you a little bit more detail how to read these things. But I thought there was some great information here. Let me know if you have any questions.